Picture this. You buy a stock, but immediately the price starts tanking. You watch the red candles pile up, panic sets in, and you finally sell to cut your losses. But the very next day, that exact same stock violently reverses and shoots straight up. This sudden reversal marks the moment when a massive influx of buy orders enters the market, specifically targeting the price levels where most amateur traders hit their breaking point. This is the moment where institutional buyers absorb the final round of selling before driving the price higher. There is a specific name for this price structure: the hammer candlestick. Today, we are going to break down a strict 4-step mechanical blueprint to identify this pattern, confirm its validity, and trade the reversal with precision. Mastering this setup allows you to base your trades on price geometry and confirmed volume, rather than emotional reactions to a falling chart. Step 1 is defining our market structure and area of value. Before we even look at a single candlestick, we need the right context. We are looking for a clear downtrend, 6 or 7 consecutive red candles, crashing directly into a strong historical support zone. Attempting to trade a hammer reversal in a vacuum without an underlying support level leads to consistent failure. Without the floor of a support zone, a downtrend carries enough momentum to break through individual candles and continue its move lower. This image shows the standard components of a candlestick. Every candle gives us 4 pieces of data for a specific time frame: the opening price, the highest price reached, the lowest price reached, and the closing price. The thick box is the body, and the thin lines are the wicks. Step 2 is our entry trigger, identifying a mathematically valid hammer. The body of the candle must be small and sit at the very top of the range. There should be little to no upper wick. Most importantly, the lower wick must be 2 to 3 times longer than the body itself. At this stage, the color of the body is secondary to the proportions. The psychology behind this shape is a battle of rejection. Sellers took aggressive control at the open, forcing the price to new lows. But by the close, buyers entered with enough strength to push the market all the way back to the opening price. That long lower wick provides visual evidence of significant, sudden demand. Let's train your eye to see the difference. On the left is a low probability candle. The wick is too short, and it has no relationship to the preceding trend. On the right, the wick is 3 times the size of the body, and it has formed exactly on a recognized support line after a sustained drop. The geometry of the candle only signals a reversal when it interacts with that historical support line. Context and shape must exist at the same time to create a valid trade signal. Step 3 is confirmation. Many traders see a perfect hammer and buy the moment the candle closes. This is a common mistake that leads to being trapped in a continuation of the downtrend. Using a stock like Tata Steel as our example, once the hammer closes, we wait for a specific confirmation. The very next candle must be bullish, and its closing price must physically close higher than the highest tip of the hammer's wick. We verify this move by checking the volume. The trading volume on that green confirmation candle needs to be higher than the average of the previous few bars. This volume spike provides the data we need to confirm that institutional buyers are committing capital to the move. Now for step 4, execution and exits. With the price closed above the hammer's high and volume confirmed, you place your buy order just above the high of the confirmation candle. To manage your risk, you place your stop loss slightly below the lowest point of the hammer's long wick. If the price reaches this level, it proves the support has failed, and you exit the trade with a controlled, predefined loss. You set your take-profit target at the next major historical resistance level. Ensure the distance to that target is at least twice the size of your risk. By requiring a minimum 1-to-2 risk-to-reward ratio, you ensure your winning trades always outweigh your losses. Following a rigid framework like this provides a binary decision-making process. You are no longer debating whether to stay in a trade or exit early. You are simply checking boxes against a predefined risk profile to maintain consistency in your results. Let's watch the result of this disciplined setup. The price triggers the entry, holds steady, and surges upward to hit the take-profit target. This checklist summarizes the 4-step framework. You need a clear downtrend into support, a lower wick at least twice the size of the body, bullish confirmation with elevated volume, and a stop loss positioned below the wick. To master this, open your charting platform, set the time frame to 15 minutes, and find 3 historical examples that meet all 4 criteria. Tracking these setups manually will help you recognize the difference between a high probability reversal and a random market fluctuation. Successful trading relies on the discipline to execute a proven mathematical edge, regardless of individual outcomes. By sticking to these 4 rules, you shift your focus from predicting market direction to managing your risk with every trade.